You want to take the the exercise is to practice this, and you'll glean right away. Don't worry about looking for market structure shifts or quarterly shifts right away. The first get a clue of what it looks like is by taking every new month, okay? Put a vertical line on the beginning of the month, and then draw out a range of 60 days to the left of it, okay? And I guess you want to see me just do it real quick? All right, give me a second. Let me create a new chart here. All right. The easiest way I do this with is, excuse me, create a little box, okay? Then double click on it and grab the end of it, and then watch the numbers over here. When you get 60 and you're on a daily chart, that's 60 days looking back. Now it's down and dirty and quick because it's in this platform, it's going to show Sundays, which I'm really not so worried about. Hang on, get this little thing out of my way here. Okay, here's 60. When I go up and down, that right number is the number of the vertical. Moving left to right, it's the first number, so that's 60 right there, okay? So there's 60. Duplicate that. Drop it down to 40. Duplicate that. Drop it down to 20. Okay? Once you have that, let me put this little question box out of the way for a moment. Okay, and then now all you do is you get a vertical line. There's the first day of January. Okay? And now what you do is you take your range, let me get these other ones out of the way. Okay, so here's January 2017. In this range of 20 days, okay, looking back, we have this right here. So we have this high here. So what's above this high? Buy stops. Is it the wick or is it the bodies? It's the bodies. It can be the wick, but it's the bodies. All the bulk of the volume is in these bodies. Where is your dollar going? It's going up to this order block. If it goes through the mean threshold, it will wipe out this. Either way, where we're at now is range to trade. So using if the data ranges, we're looking for that move here, 107.62, or basically 107.50 to 107.60. If we see it move to the run on the high, there's the liquidity there at 108.70, right? 108.70. I hate when it does that. You ever do that? Try to find the level and it jumps over the one you want. It'll do every other number but the one you want. Then we have the sell side liquidity below the lows here. Okay, so inside these 20 days, you have this high here, and you have this high here. As price was down here, the next level of liquidity is going to reach for here, And then here, we've already wiped that out today. So this level is gone. This high's been gone here. Now this level here, bodies and the wicks, that's been blown out. Okay, so the next level that we're watching for is on the upside, 107.20. Bearish order block, gap. Both of them overlapping with one another, so it's really the same thing. 107.20 still answers that equation, whether you're looking at the gap where price is only been delivered on the downside. This candle or the very next candle or Monday's candle will probably see it trade up into 107.20. It goes through, clears out these bodies of these candles. That will be the next level we will be reaching for. And then price would most likely want to reach up into here, right above this high, taking us back into this old area of institutional order flow back there. Then the next level, if we continue bullish, it's going to want to run into this high up here. It could start with this low, because it's all these candles are, it's 1, 2, 3, 4, all up candles, so that makes a bullish order block, all one block. So you would have to look at it like this. 109.62 to 109.75-ish. So there's the areas at which IPTA will want to draw price up. Now, how you use this information if you see these levels fail and it starts to break down? You're going to look for the market to run down below this low. It does not have any indication it wants to do that here. That's not suggested here yet. But if we start to break down, it would look for this liquidity here. And now here's the big takeaway is 60 days back, there is no low from this point on here. This is the low on that month. Then we have this low for November, and then the lowest low in the last 60 days is what was made on this day here. So if we break this low here, what are we doing now? We're going to have to jump a great deal. And that tells you that we have a big, larger move that can't be seen on this time frame. You have to go out. And it's down here. We have an old high back here. The next level would be if it would reach for that. So 102.09. That would be the next downside if we lose December's low. It's not indicating it yet, but that's what would happen. And then you would continuously nest that out. And then it would be this low here, and you break it down outside of the last 60 days. But if price ever takes out a range of the last 60 days, it's a significant impact on price action. It's going to indicate that it wants to move a great deal. Now, it can sometimes go outside of the range of 60 days and then reject, and that's a turtle soup. That is the only caveat that will have an impact on your trading. If you break out of the last 60 days range, usually it's a long-term trend continuation. If it breaks out of the last 60 days range and comes right back into it and shows signs of rejection was seen, that means you have a reversal underway, and it's probably going to go the opposite direction a long time. And you'll see examples of that as well. But you just do this. That was for like January. Let me go back into a daily time frame. And in December, right here, all you do is you can have one chart to do this all the time. You just rotate it forward. Take this off for a second. Okay, so we have December now. If we do the exercise there, looking back 20 days, we have a low here. Price goes below that low here, so it's seeking liquidity. Below that low, we have a high that's not going to be any significance, and there's no other reference points except for that low here. and it moved outside of the range of 60 days, only on the downside. So the lowest low is this one here. We saw rejection after this low was taken out. And casting forward, this is how you do it. You know you got 20 days expected to see a significant low form or high form. And what you do is you have that range and time delineated on your chart. Okay, and so they have a point at which you can put your vertical lines in. Once you have the beginning of the month mapped out, like with a vertical line, you go 20 days, 40 days, and 60 days, and that's your range where you anticipate where those highs are forming. In the first 20 days, you have the lowest low here. Okay, so inside of 40 days range, it came down, took out that low, and then rejected, came back up. So what's it going to seek? The highest high next here. Then you have this one here in this 40-day range. So since we broke the range of 40 days, what's it looking to do now? The range for 60 days, that's this high here. So the only thing that the algorithm's doing is saying, okay, this is my delineation at this month here. Where's the liquidity looking back 20 days, 40 days, and 60 days in the form of a high and a low? And is there any efficiency in price where I only saw, or the algorithm sees, that only sell side was offered? There was no upside back from that point. So on this day, there was between this candle's low here, there was no up movement, no trading up at all once that candle came down. This came up to this point here, but it left this candle's high to this candle's low. That little area is a gap. So price will look to rebalance that, and the algorithm will look to fill that in right there. We went into it a little bit today, but it's going to want to close in that little portion of this down candle. Price only moved down there. To rebalance, it has to be offered when it goes up through it. And it can only spike up like it did with the dollar index. Here, it traded down. It came up there, hit that, closed it in, and then closed lower. And then we went down below the sell side liquidity like we were talking about, expecting to see. And you see it here. Same thing should be seen with the US CAD. Went down below this low. That's where it's seeking. It's seeking that liquidity. It blows down below it. We were just looking at Aussie cable. Came back up into the last up candle's body. Filled that in, which is all of this down candle. When this candle went down here, there was no other candle that came up in to cover over top of the range that this down candle is shown or delivered price on. So price goes up into that, closes it in. At one moment, this was a bullish candle today. That bullishness overlaid the down move here. Perfect price delivery is always passed through down and up, or up then back down through it. That's how the algorithm operates on every time frame, because price is fractal. So by having that in mind, when we go back to our Australian dollar example, no, euro dollar rather, euro, when we have our levels that we shoot forward in time, they're just ranges at which we focus in on where the highs and lows are. We're not looking outside of that range of 60 days back and 60 days forward. To do anything outside that range of time, you're not operating in the same way that the institutions are looking at. They're looking at where the liquidity is in the range of the last 60 days, and then knowing that, they're going to cast forward 60 days, and every time a new range is created, like it creates this high here, for the next 60 days, which I can't even show because the chart won't do it, but we have a lot more time for this high to be taken out. This high is taken out here. This high is taken out here. We have the last 20 days, the low was violated here. So inside the last 40 days, this is the low. So sell side liquidity is here. And we have a new month in January there. So if we take a 20 range, place it on there, This is the low in January, so the liquidity is resting below this low in January. Let me see if that candle's lower. Yeah, it's this one. This is where the liquidity is below here. So sell side liquidity is below here. Buy side liquidity is now above here and above these bodies because we've cleared out the high here, which ended December. So this is the highest high of the month so far for January. So there's no more buy side liquidity or stops until we get above the bodies here or this wick. On the downside, we have liquidity below this low and below the low of this wicked candle. So that's where the institutions are seeing buy side and sell side liquidity. Let me take this off here so it's not confusing you. Oh, didn't want to do that. So right now, going forward, a real live example of using it and what everything is telling you using this information. Because it's one thing to talk about it in hindsight and say, oh yeah, this is how it was wonderful here. I want you to see going forward what you do with it. Oh, good grief. Okay. So we have 40 days range still. We've already passed through the 20-day. I'm sorry, we haven't passed rather through the 20-day. So we have a range up to this point here. As we make a new high or if we make a new low, in that range we identify it, and then we start working towards the next 40 days. And we're looking for the last, where those old highs are over here, we're looking for where the liquidity is in reference to that look back period of 60-day, 40-day, and 20-day. Once we have a new month for our exercise, you just cast forward 20 days, expect a higher low to be violated, and study that. See what the liquidity run was. Was it for the buy side or the sell side? And by doing that, and also looking at when it happened, did it make a move that broke market structure higher or lower? In this case, we see what? We see an old low in December. Short-term high here. Price runs through that. We have a short-term high broken. Market comes down. The low here, right there, lower low, and then it trades today higher above this high. So now we have another market structure shift potentially right now, live, right now, looking at the, get this thing on here. There you go. For January, for the rest of the next 3 months, we're looking at bullishness for Euro. Why? Because this short-term spike up here was violated today. So market structure is broken to the bullish side right now. Institutional order flow is now, for daily, higher. We would anticipate seeing price move above these candles up to this level here, this last up candle, which is the bearish order block, run above these equal highs, and then make a run above into this wick, back up into this level over here. Because all this is back in 60 days look back. This low is in the 60-day look back period from this candle or this January starting point. In simplest terms, and it's probably in your own mind been made very complicated because of the way I'm trying to explain to you. And admittedly, it is kind of difficult to articulate sometimes. But all you're doing is really just looking back. Where's the buy stops in the last 60 days? The highest high form of buy stops. Where's the lowest lows sell stops in the last 60 days? And then cast forward 60 days, 40 days, and 20 days, and you're looking for the highs that form in the next 20 days, and then looking for the lows that form in the next 20 days going forward. And as that happens, it changes the near-term liquidity at where we're at in relative terms to current price action. Always being mindful of the look back of the last 60 days. Where's the highest high and the lowest low in the last 60 days? And in the last range of 20 days, and the last range of 40 days. It takes all the ambiguity out of what high and low I should be looking at. Where's the buy stops? Why am I looking at that low and not something else? and it's dynamic going forward. Every time, like right now, we have this low. So while there is sell-side liquidity below here, this one now becomes an area of sell-side liquidity or sell stops below that low because we've moved away from it. Any previous candle to this one, high has been violated, like this one here, that happened today. So now they have trailed their stop losses up below that low. So liquidity rests in the form of sell stops right below that low. Okay, so I'm going to have to close this video. It's way, way longer than I wanted it to be. And actually, at this point here, I'm going to have to probably do 2 of them. The server won't let the size permitted. I think it's 500 gig. I think, or something like that, 500 meg or something like that. I don't recall what it was that it limits me on, but I'm quite certain I'm over the time limit. So, actually, I'm not recording, am I? I just remembered that. So yeah, I'm talking for free, but a lot of this information I probably would have been better off having it in a recording. So, for those that stuck around, well, you got a bonus, didn't you? No, I didn't record. I just realized it. I didn't expect to talk this much, but I am getting hoarse. Anyway, I know a lot of you are excited, and some of you are like still scratching your head about it, and that's a normal thing, okay? But just know that all you're doing is highlighting on your chart. Look back 60 days from the beginning of every new month. Circle those highs and circle those lows. For the next 20 days, the next 40 days, and the next 60 days, the market's going to look to go to those levels because that's where the orders are. All right. Some of the ladies are in here like, I'm still scratching my head, but I'm excited. All right, so I promise you that we will have plenty of examples of this because we'll be using it going forward, and you'll know why I'm looking for liquidity runs above old highs and old lows and why it makes sense, okay? But I'm going to escape. Wish you all a good afternoon. Like I said, give me some time to get this stuff online. This video will probably be on after 6 o'clock because I do have soccer duty with my son tonight, and we also have to do homework and stuff. So, I got to get off here right now and take a look at the markets for today's recap for today's entry. But this is the teaching for using IPTA data ranges. So that will be the contribution to our teachings for the month for that module. And you can see I think I got 2 more titles up for the videos I'm working on. I'm building slides for those. They will be up tomorrow. So you'll have 2 teachings tomorrow and a weekly recap video tomorrow. So you have this video today we did for the live session, which will constitute the supplementary teaching for using IPTA data ranges. You'll have a recap video, and then tomorrow you'll have 2 teaching sessions, and then you'll have a recap for the week. So there'll be 3 videos tomorrow, and that'll close us out for the week, and I won't be doing anything for the weekend. And then I'll resume again on Monday. You'll get 2 teachings on Monday, and then Tuesday you'll have a live session again with me, and hopefully have 2 more teachings that I can upload on Tuesday night, and then Wednesday I'm aiming for 2 more teachings. Then it's a lot of teachings this month, so just letting you know it's a lot. But I appreciate your patience in allowing us not to have to be here on a daily basis, but we will get through this month rather quickly. You'll see how quickly it goes through, and you'll have a lot of content, and then you can resume back to doing more daily sessions over live charts. Okay? Have an awesome day. I hope you learned something today. Stay motivated. Don't let the hard work scare you away.